Okay, so after learning about the concepts of future and present values in our previous videos, we can now proceed with the net present value method under the discounting method. Okay, so NPV. Actually, this is the difference between the present value of the cash inflows and the present value of our cash outflow. Our cash outflow normally refers to the initial investment, okay, over a period of time. So again, NPV is just the difference between the present value of your cash inflow and present value of your cash outflow. Okay, so to use the NPV method, normally this requires the rate of return. Okay, so this rate of return is normally our basis as, or is being used as, the minimum acceptable rate of return. Okay, so this will be our benchmark. So normally, your NPV should exceed, okay, this minimum acceptable rate of return so that the investment will be acceptable. So this is also referred to the rate of return, or minimum acceptable rate of return, is also referred to as the discount rate. In another term, they also name it as hurdle rate. And this should correspond also to the cost of your capital. Okay, because this will be the basis later on if we will accept or reject the investment. So the cost of capital, okay, so this is normally the weighted average of the cost from various sources. So we weight them relative to its amount depending on the source. So cost of capital, normally this is the correct discount rate that we will use as the basis for accepting or rejecting the investment. Minimum required rate of return. So although in practice, some firms choose higher discount rates as a way to deal with uncertainties in the future cash flows. So to just give an allowance, okay, for possible losses. So the net present value method, yet this is the cost of capital already embedded uncertainty in its value, the cost of capital. So using higher discount rates may create, however, an unhealthy bias. Okay, this is just the problem. Okay, so thus it will generally be assumed that the cost of capital is therefore our required rate of return. So this will only be used, of course, if the cost of capital is given or we are able to compute for the cost of capital. However, if these data are not given, then we will use the other rate that is also used as the basis for rejecting or accepting the investment. Okay, for our general rule, okay, for the acceptance and rejection of the investment, so if your NPV is positive, meaning to say the initial investment is able to be recovered, the required rate of return is also recovered, and a return in excess of the cost of investment in the rate of return has been received. So meaning to say, if NPV is positive, we will accept the investment because the net present value of the investment is greater than the cost of investment. Okay. In the second case, if NPV is greater than 0, okay, or greater than 0 or positive, okay, also, then the investment is profitable and therefore acceptable. Okay, NPV is greater than 0 or positive is the same. So it also conveys the message that the value of the firm should increase because because it is more than the cost of capital, and its earning also is more than the cost of capital. That's why the investment right here is accepted. What about if your NPV is equal to 0? So here, the decision maker will find acceptance or rejection okay, of the investment to be equal. So again, actually normally, this investment can be accepted because the cost is just equal to the present value. Or depending on the decision, they can also reject it because there is no additional benefit that is being received out of the investment. Okay, so just neutral. What about if your NPV is less than 0 or negative? So of course, the investment should be rejected because in this case, the earning is less than the required rate of return. This investment is losing. That's why it should be rejected. Okay, to understand better, we have here the illustration, okay, or example. So we'll use the Paulson Company. So they consider producing a new cell phone with the following associated data. So we have the expected annual revenues of $750,000, projected product life of 5 years, and the equipment is $800,000 with a salvage value of $100,000 after 5 years. So the expected increase in working capital is $100,000. However, it will be recoverable at the end of 5 years. So your annual cash operating expense is estimated to be $450,000 and the required rate of return is 12%. Okay, so based on the data, we will first compute the required investment, or this is our present value of cash flows. Okay, so here, this is equal to $900,000. So its composition is cost of equipment, that's $800,000, plus the additional working capital once we invested. Okay, so that's equal to $900,000. Okay, so this is our present value of cash outflow. What about for our cash inflow? So for the cash inflow, we have the following. Okay, so revenues, additional revenues of $750,000. However, we also have the operating expense of $450,000. Okay, salvage value is recoverable at the end of the life of the investment. Okay, and then we will also recover the working capital. So therefore, the net cash inflows is $500,000. Okay, another this one is the present value of cash inflows for the 5 years. Okay, this one, or after 5 years, I mean. This one is for the first to fourth year. So we have revenues every year of $750 and operating expense of $450. So every year we have a net of $300,000. Okay, so we separate this one with this one because these present values can only be recovered after 5 years. Okay, this one is for the first to 4 years. Okay, so to continue, okay, so we have this table. Okay, so here, 0, year 0, meaning to say this is the time which, okay, we invested our $900,000. So the discount factor right here is 1. Okay, this is our present value of your cash outflows. Okay, this 1 right here, the cash flow for the first to 4 and then the 5th year, this is considered to be our cash inflow. Okay, using our discount factor, that is also located from the discount factor table. Okay, so this is 1 to 4 years with a 12% interest rate. Okay, so this is added. That's why it becomes 3.037. Or you can also locate this from the Npv, okay, the discount factor. Okay, multiply the cash flow with the discount factor. So this is our present value. Okay, for the 5th year, the same also. Okay, so therefore, to get the net present value of the investment, all you have to do is to deduct, okay, from the present value of the cash inflow, this present value of cash outflow. So therefore, our net present value is $294,600. So if you could notice, our net present value, NPV, is positive and more than 1. So therefore, as a general rule, this investment is acceptable. Okay, so that ends our discussion about the discounting method for net present value.